I'm Paul Carroll. I'm the editor-in-chief of Insurance Thought Leadership. I'm here with Ty Sagalow, who is founder of Innovation Insurance Group, and we're going to talk about cyber. Ty, you wrote a piece for us back in September that said people ought to be thinking about cyber insurance, and lo and behold, everybody is. What's happened between September and now?
So there's been an increase in the interest in cyber insurance, certainly since September and before. Cyber insurance is about 12 years old and is now a $1.3 billion industry. The interest arises out of, among other things, a number of high-profile cyber events, including the cyber attack and theft of personal identifying information from Target and Neiman Marcus.
Right. So let's maybe start with the insurance company standpoint. What are insurance companies doing to innovate, adapt, or whatever they need to do to start serving this market that seems to be of interest to a lot of people?
Well, like many insurance policies, service is as important as financial reimbursement. So in the cases of theft of personal identifying information, the better products out there, and certainly leaders in insurance, not do more than just provide financial reimbursement, but they provide services in forensics, crisis management, and of course, notification.
And this is something of a moving target, right? Because there are some existing policies that people are applying to data breaches and so forth, but the insurance companies are reacting, and then people are having to buy specific cyber insurance to cover some of the things that would have been covered by other policies. Is that right?
Well, as the saying goes, it's deja vu all over again. So in many ways, cyber is the old EPLI. When employment practices liability first came out, there was a sliver of coverage in general liability policies. At the time, and after a time, the insurance industry realized that the exposure associated with employment practices was unique and needed its own insurance policy. Now, of course, almost everyone buys EPLI.
Right.
So we've seen this movie before, and it's happening again with cyber. There was some attempts to see if there was cyber insurance in some traditional forms. The most recent case, of course, is Sony versus Zurich, in which the policyholder lost, and it was determined that there was no theft of personal identifying information arising out of a general liability policy. So we've seen the movie before, we know how it ends, and I expect that within the next 5 years, cyber insurance is part of a standard risk management portfolio.
Okay. Are there any companies that are doing especially innovative things in terms of cyber insurance?
Yes, there are. I mean, there are innovation happening in this area through many, many companies, and I'll name two, but that is not to say that there aren't innovation happening with other companies. Beazley has always taken a very interesting approach to their breach fund by covering unlimited number of expenses associated with the theft of a defined number of records. I think it's a very innovative approach, and I think it's an approach that other carriers will begin to seriously look at.
Okay.
Of course, this week, the talk of the town is AIG's additional approach to cyber, in which they are adding coverage for bodily injury and property damage, excess, of course, of the company's property and GL policy, for a cyber attack that results in that type of damage. It is a very innovative concept. It is, I think, something that's very important, and I would expect it's going to be followed by other carriers over the next few years.
Okay. To flip things and now look at it from the policy purchaser standpoint, is there anything in particular people ought to be doing there?
I think if you haven't looked at cyber insurance yet, you need to take a serious look at it. A few years ago, the purchasing was only about 7% of companies purchase cyber insurance. A year or so ago, most statistics were saying 30 to 35%. Now you're seeing statistics into 45 to 50%. So if you haven't looked at it, you need to look at it. The second important lesson that I would give to clients that are publicly traded is that the Securities and Exchange Commission in December of 2011 sent out a guidance piece that indicated that cyber risk is and may well be a material risk that needs to be disclosed pursuant to the Securities and Exchange Act of 1934. Now, usually what happens with the SEC is that they put out that type of guidance, and then, about 2 to 3 years later, they selectively start investigating companies whose 10Ks and 10Qs haven't made full disclosure.
Okay.
Well, now is the time that's going to happen, and just, I believe this month, the SEC put out an additional guidance regarding mutual funds, saying the same thing.
Okay. So if you look out 5 years, it sounds like one thing we're going to see is that cyber is split off and is its own form of insurance. But if you look into your crystal ball, what else do you see for cyber, let's say 5 years from now?
Well, I think that there'll be additional limits that are available. I think there'll continue to be more players. Now there are about 40 different players that have standalone cyber insurance. I would expect that to continually increase. At Innovation Insurance Group, we have a number of clients that are not yet in the cyber insurance space. I'm talking about carriers that are seriously looking at it, and really there is no choice. If you're not in it now, you're going to have to go into it.
Right. Okay, that's great. Thanks, Ty.
Well, thank you, and thank you for inviting me.